Well, here's what you do. You ask the experts where to go. And to help us ask where the best place to be in investing, we're going to bring them in. For the charts, we have Bob Iacchino, founder of the TraderOutlook.com. He's out in Chicago. And Jan Lowe's chief market strategist over at JP Morgan. Jan, let's start with you. Adam's telling us there's nowhere to hide. How about where do you want to be? Where do you want to invest right now?
Well, clearly not in stocks, clearly not in the cyclicals. Energy is probably the worst to be at the moment. It's getting hurt both by turmoil in Europe and the global slowing that we're seeing. Industrial production probably contract this month or this quarter. In order to hide somewhere, you need to get out of equities. You need to be in the fixed income world. And they're actually broad corporate debt, high grade, even external debt is a much better place to be. The spreads are widening, but you get downside protection by the rally in the underlying treasury. So high-grade credit overall is the best place to be at the moment.
Jan, your job at JP Morgan is to help all the JP Morgan clients around the world try to figure out where around the world they should put their money. So with what you've just told us about equities, the fact that you think you should actually scale back, what's the actual amount that people should have in equities right now?
But relative to their normal, their strategic allocation, that should be underweight at the moment. Probably not by a lot, but nevertheless, I think the major underweights have more to do with commodities. Equities, a modest underweight, I would say, in particular in the riskiest places in the world, which are cyclicals and which are in Europe.
Bob, I'm going to bring you in here. Since you're the founder of TraderOutlook.com, well, we've got to ask you the question. What's your outlook?
Nice play on words. I like that. Look, when you look at a chart right now in the S&P especially, and it mirrors in the NASDAQ, it mirrors in the Dow, but it's really dramatic in the S&P. You're not seeing any sort of dips that are buyable. And what I mean by that is, as a technical trader, I don't look to pick bottoms. I've been doing this 19 years. I think I've picked a bottom once, and it was sheer luck. What I look to do is I look to identify bottoms and then look for basing patterns that will possibly give me an idea to catch that hot air balloon on the way up. I don't want to catch a falling knife. Technical traders have all kinds of theater of the obvious cliches that we use, but I really want to identify bottoms, and the next bottom to the S&P to me is about 1285, but that does not mean that I buy it there. It means that I watch the price action around there and look for some sort of basing. I would rather buy it on its way back up and miss a few percent than catch it on the way down. It's about the risk. It's about the risk you're willing to take in that trade.
Hey, Bob, help the viewers understand right now the cost of insuring portfolios. The VIX has been moving up steadily, which makes options more expensive. What's your take on buying, say, S&P put options right now under this scenario where stocks may go lower?
Well, I'm not really an options guy, but what I do like to look at is if you're interested in owning the stocks, the options are a good place to do it. If you've already owned the stocks, that protection is very, very valuable. The VIX is steadily climbing, but it's still relatively cheap versus its crisis levels in the 30s and 40s that it's gone to. So if this crisis accelerates, those puts will look like they were cheap when you failed to buy them. So if you like the stock and its fundamental thing, and that's not really my area, but if you like a stock fundamentally, options is a great place to protect that and hold it depending on your time horizon.
Bob, is it really possible to call anything cheap when there's so much uncertainty that lies ahead?
Cheap is a relative term. Okay, it's absolutely relative to where it's been. The VIX is cheap to where it can go and where it has been during the crisis. And, in terms of where volatility could be, if the euro explodes, if the single currency just completely disintegrates, volatility will look cheap in the future. But remember, the main focus for individual investors in the options market is as insurance, not as a trade. So you got to look at that from a fundamental perspective of, do I want to own this stock long term? And if you do, it will look cheap if something happens.
Jan Lowe's, head of global asset allocation at JP Morgan. You mentioned that you don't like commodities. You think that the energy sector, at least energy equity, is particularly vulnerable. Is there one sector that maybe is starting to catch your eye where you say, okay, if we find the kind of bottom that Bob is talking about down another couple percent, I might actually tell JP Morgan clients to step in?
Well, the one with the positive momentum is clearly the technology sector. It's least affected
Which one of them's coming back?
It's least affected by what's happening in China and in Europe. It's got positive momentum. There's decent optimism around. The positions are overweight, but they're not horrendously overweight. So I'd rather be in technology and a few, I would say, high-yielding stocks. broadly the utilities. They're low beta. We're in a deflationary environment, so anything with yield is going to be favored. So make it make it technology and utilities as my favorite sectors.
Jan, thank you. I know we'll have more from you later in the hour. Jan Loeys, Chief Strategist at JP Morgan, and Bob Iacchino over in Chicago at TraderOutlook.com. Thank you both, gentlemen.